Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Just a reminder that anyone that is registered for today's program will be receiving a copy by early next week. Joining us today, we have our good friend, Cox Senior Economist Charlie Chesborough. Charlie, thanks for coming on today. I'm sure there's a lot to cover, so I'll let you have the floor.
Okay, well, thank you, Rachel, and thank you to everybody for tuning in today. We're going to talk about the automotive outlook, and I've titled my presentation Slippery Road Ahead. And if you can see the picture, you can see I've got a barrel of oil that's spilled out onto the highway just around the corner here for this vehicle. And that's really kind of summarizes the situation that we're in right now in the U.S. economy. The war in Iran that was started at the end of February, beginning of March, saw a huge spike in oil prices, and historically, we've had many instances where we've had a run up in oil prices and it's forced the U.S. economy into a recession. And I'm going to talk a little bit about that. The danger is if it's just a short amount of time, many times the consumers can just absorb it, doesn't really impact behavior. We just kind of move on from it. It's not a big impact. But if it's an extended period of time and consumers are really forced to pay high prices and businesses is forced to pay high prices for an extended period of time, then it can have very detrimental impact on the U.S. economy. The question is well, how long? We've been at this high prices for about 3 months. Is that enough to send us into recession, or is this ending in time that we're going to skirt that? And we just don't know yet. And I'm going to show you some metrics out there that kind of indicate an argument in both directions. So we're going to talk today about the economic and automotive outlook. Is there a recession ahead? And if so, where might we see some vulnerabilities in the vehicle market? Then I'm going to talk a little bit about the market trends that we're seeing out there, and we are seeing inflation pressures rising for vehicle prices, particularly in the used car market. And then I'm going to finish up by talking about hybrids. That's kind of the big story here of 2025 and 2026. People are really flocking to these hybrid vehicles, certainly in the wake of high gasoline prices. But also, I think many of the Japanese have converted or are offering many of their products in a hybrid option. I think that's been particularly of interest to consumers these days. But let's talk about the economic overview in general, and this is just kind of a summary. And what we're seeing right now, as I said, recession fears are rising. We still have positive economic growth. We grew at 1.6% in the first quarter, and that was up from the half a percentage point increase we had in Q4. And expectations are we're going to have about 2% economic growth in the second quarter, where we're in right now. But again, it's this Iran war. It's increasing production costs. It's increasing energy costs. At this point, consumers and investors are still buying, but we don't know for how long and if they're going to get derailed. So that's why we have a lot of concern out there. And the K economy, which I'm sure you've heard of, where you have the high-income people are doing quite well, the low-income people are doing not very well. That's really expanding, and certainly we can see that in the market today when we have record high stock market and record low consumer confidence. And I'll show you a few slides on that as well. And inflation is the big story that we're dealing with right now. It's starting to tick up. It's starting to heat up again from where we were. It's at the highest point, actually, that we've had in the last 3 years. The question is it going to start rolling up higher? And that's where it can kind of send the economy into a recessionary environment. And the fourth point is this roller coaster is going to continue. Uncertainty is really the only certainty that we have right now. The best strategy I can give you is hope for the best and plan for the worst, because we really are in some unknown territory right now here with the U.S. economy. But I will say, I think things appear to be turning a little bit more positive. Certainly the news of the war possibly being over is going to be a big plus for everybody, for vehicle sales and the market as well, stock market. All right, well, let's talk about crude oil prices, because this is really the big story that we've been dealing with here over the last 3 months since I last spoke with all of you. This is a chart that's showing the monthly West Texas Intermediate crude oil price, and it's going back almost 50 years worth of data. And the key point out of this, as you can see on the far right, we've just had this huge run up in oil prices. We went from about $60 a barrel up to over $100 a barrel, and we were there for almost 2 months, 2.5 months. It's now started to come back down. But when we look back in historically at different periods where we saw a big run up in a short period of time for oil prices, we've had U.S. recessions occurring either right around it or right after that happened. And I don't even have the recession, the OPEC recession from 1973, which was certainly led by a huge run up in oil prices. But we can see we had the double dip recession of the early 1980s that happened around the Iranian Revolution, and oil prices doubled. We had the Kuwait invasion back in the early 1990s, the start of Iraq War One. That had a recession here in the U.S. economy, and oil prices doubled then as well. And so we've had a history of this, and the concern is, as I've said, is that have we gotten to the point that it's happened long enough that it's going to derail economic growth? Again, don't not seeing it yet, but it is something that we're keeping an eye on. And this is why inflation is really a major concern out there. We've just gotten the most latest data point from May, the year over year change in the consumer price index, and it was up 4.2%. And you can see there on the far right, it's really made this big jump. And that's just from the month of May. We're probably going to be looking at elevated inflation prices throughout the summer. They may even creep higher. We just don't know yet whether they're going to stay sort of in the 4% range, or does it go to an even higher point from here, given the cost of oil around the country. This is really dangerous because what happens is that consumers see these high prices and they generally start to conserve on their spending. When certainly the gasoline prices is impacting their disposable income, it's costs that they can't escape from because they still got to get to work, they still got to drive their car around, and it takes away their ability to spend money on other things. And so it's kind of that combination of conserving my money, I don't buy as many things, that kind of leads consumers to pull back, and that's what causes a recession. And so that's the concern we have now. We're well above the Fed target of 2%, and the Fed met yesterday and basically gave guidance that they're concerned about inflation as well. And many folks, when we started this year, were expecting that we'd have a couple of interest rate cuts throughout the course of this year. But now the odds are really increasing that we're going to have a rate increase, that the Fed is now going to have to start to slow the rate of inflation to keep a control on it. And so there's a real possibility now that before the end of the year, sometime maybe in November, December meeting, we might see the Fed start to raise interest rates. So that's part of the reason that we saw the stock market down yesterday. So we're dealing with this inflationary environment, and that's having a dramatic impact on consumer sentiment. And this is a chart that's from the University of Michigan that's, again, showing consumer sentiment back almost 50 years. And you can see on the far right of where we are today, we are very close. We're just off all-time historic lows for this metrics. Consumers are saying that the economic environment today is worse than the double dip recession of the early 80s, worse than the Iraq war crisis, worse than the the 9/11 attack period, worse than the Great Recession. It's really quite phenomenal how bad consumers are saying things are out there. And this is where I think it really becomes clear, as I mentioned, this K economy differences. We're looking at the Dow Jones over the last year. It's up 20%. The S&P 500 up 25%. Gold up 30%. And yet consumer sentiment just over the last year has fallen almost 20%. So it's definitely a mixed bag out there, with those folks who are invested in the stock market are still doing quite well and are probably fairly optimistic on the way things look right now. And who could blame them when you're getting those getting those kinds of returns? But again, the danger is that consumers, when they're at this level, generally pull back on spending, and that's what causes a recession. And we've seen it many times before. When we see consumer confidence make a big decline, it generally is followed by some sort of major pullback in economic growth. And the other interesting thing, though, is that not all consumers are in agreement as to where we are today. And this is a chart that's showing consumer confidence by political sentiment or their political affiliation. And the key story here is that Republicans still remain fairly optimistic, or at least relatively speaking, more optimistic than independents and Democrats right now. And really the key point of this for us in the vehicle market is this may impact who's coming in to buy a vehicle these days. Generally, as I said, you need confident people who are going to take out a $50,000 car loan. They have to feel confident about the economic situation, their own job prospects. They have to feel confident about that in order to take out that size of loan. And so we can see today that you would not suspect that many blue or purple state folks are feeling too optimistic right now. So this may impact who is buying in the market. But clearly, the situation is one where everybody, even the Republicans, are seeing that their confidence is much lower than sort of what it has been historically, and certainly much lower than where we were back in the pre-COVID days. And so all of this is sort of weighing on this environment in the economy of just dissatisfaction, of concern about affordability, and all of those main kind of negative feelings that we're getting in the U.S. economy today. But there is some positive news out there, and one of those is job creation. This is a chart that's looking at monthly employment gains, and you can see here, I've highlighted in yellow that we've just got the revisions for the months of March, April, and May. And we actually saw job growth get much stronger. And that's after having a couple of months where job growth was very weak. And there was a lot of concern. Just, I think the last time we met, that we had a couple of months of very, very weak job growth, in fact, in negative territory at one point. And so there was real concern that maybe we are now slipping into this recession, that the economy is not able to maintain the growth standards that we need in order to keep employment full. And there was real concern that was happening, but you can see that over the last couple of months, it's actually picked up. And so this is one of the things that we're pointing to that suggests that maybe we are going to miss this recession, that maybe we can grow our way out of this, that things aren't quite as dire as what consumer confidence indicators and some other things might be suggesting. Overall, the unemployment rate looks quite healthy. This is a chart that's showing the national unemployment rate, and it currently stands at about 4.3%. We've been kind of bouncing around this level for about the last 6 months now. Really hasn't made a dramatic change, and it certainly remains well below the long-term 6% average that we have had in the U.S. economy, at least over the last 25 years. So part of the reason, though, that we're not seeing the unemployment rate get rising very much is that we have limitations on labor participation. There's just not as many folks being made available for employment in the U.S. market. Not as many folks are actually looking for jobs. So that's helping to keep the unemployment rate relatively stable. And part of that is being caused by the immigration policies of the Trump administration. We don't have as many immigrants coming in, so we just don't have quite the labor supply that we have had before. And the positive side of this is it's keeping the unemployment rate relatively in check, but it may not be capturing some of the issues that may be going on in the economy of businesses trying to get labor. They're just not able to get access to labor because it's not there anymore because of the immigration policies. So when you combine it all, one of the reasons why there is still concern, though, that we may be looking at some type of a downturn ahead, I think is kind of summarized by this slide. This is looking at real personal consumption expenditures, the year-over-year change in monthly expenditures, and the year-over-year change in real disposable income. So how much change in income do people have coming in, and what's the change in the spending that they have going out? And real personal consumption expenditures are a very important part of the U.S. economy. You and I going out and spending our hard-earned money is about 70% of economic activity in the U.S. economy. So it's very important that consumers are out there spending. And what we can see from that blue line, in fact, is that yes, they are still spending. It's been drifting down a little bit over the last year and a half, but on the whole, we're still seeing that consumption expenditures are growing at about a 2% rate. Certainly nowhere near anything suggesting a recession. But real disposable income, the growth of people's incomes and being able to spend that money, is actually starting to go negative. That income growth is now not in the positive realm, and that suggests that we expect that at some point down the line, in the next couple of months, consumers are going to have to respond, and they're going to have to pull back on their spending in order to match the income that they now have coming in. So we're still sort of on precarious ground as to whether this oil crisis is going to have an effect. And really, the only time will tell here. We'll just have to watch the numbers over the next few months. But one of the reasons we may not have to worry about it too much here in the vehicle market is because we are a bit isolated from the overall US economy right now, because we have a much more wealthy vehicle buyer today than we have had in previous time periods, and certainly probably during any other previous recession that we've had. This is a chart that's looking at new vehicle sales, and it's looking at it by income group, how much household income uh, was had by people and what percentage of the market they are. And the big takeaway here is that we're seeing a huge increase in more wealthy people in the new vehicle market. And part of that is wealthier people are being created from the stock market. And part of that is that lower income folks are dropping out of the new vehicle market. They can no longer afford vehicles at this price. So all that remains are higher income people. And the market is changing dramatically. If we look at these numbers, the key takeaway is that the share of the market that was people with incomes of greater than $200,000 was 18% of the new vehicle market in 2020, and now it's 30% of the market. And the share of the market that had households with less than $100,000 of income was 50% of the market in 2020, and is now just 36% of the market. And we can see where it's really moving is that the upper echelons, that $250,000 plus, is where we're seeing the greatest growth in the new vehicle market today. And it's not surprising. We know that affordability issues are out there for people with these vehicles. So it's not surprising that only the most affordable are able to buy new vehicles, and I think that's always been the case, of course. But I think the trend that we're seeing is that it's growing and growing and growing, and that's a trend that's not likely to change anytime soon. But it's not just the new vehicle market that we're seeing this; it's also in the used market, and this is looking at people who bought an off-leased vehicle, so essentially a CPO type vehicle, and what were their incomes. And again, the key takeaway here is that we've seen a 10-point move over the last 5 years of the share of even used CPO vehicles. 24% of those buyers now have incomes greater than $200,000, and it was just 14% 5 years ago. And the share of the market less than $100,000 for these CPO vehicles has gone from 57% to 44%. And so the takeaway that I get from this is that even in wealthy people are looking for a bargain out there, that we would expect that affluent people might not be so concerned about vehicle prices because they don't need to be. But what we can see here is that they're still looking for value out there as well. And so this is a trend that we're seeing across the board in both the new and the used market. And what does that mean? Well, it means that we may have some vulnerabilities here if we did have a recession, because we would expect that if we saw any kind of a downturn for the new vehicle market, that probably the lower income folks would get hit hardest, or at least would take the initial punch of any kind of an economic downturn. And that's assuming it's not a stock market crash. It's just more of your general economic slowdown, layoffs, that type of a thing. It's sort of a normal recession, if there is such a thing these days. But what we've seen in the new vehicle market is that we've had a couple of years ago in the early COVID recovery days, we saw that subprime was a very small share of the market. It had fallen to less than 10% of the market was buyers that had a FICO score of less than 620. But what we've seen over the last couple of years is, as the economy has recovered from COVID, as the vehicle market has recovered from COVID, so has credit availability to subprime buyers. And they now stand closer to 20% of the market here in 2026. So we were a little bit insulated from any kind of an economic downturn because we had a very small share of the market that were people of lowest credit quality. But it's now a much larger share. It's about 20%. And so there is a large chunk of the market that could be at risk if we saw any kind of a significant downturn. And I think it's important to note that as we look for growth in the new vehicle market, it's really going to be from these subprime borrowers out there that to get real growth, we've got to get more lower income people out there to be buying new vehicles. And that's going to be a real challenge, with these high vehicle prices that we have. And of course, all the other costs that are involved around new vehicles in terms of insurance and maintenance and all of that. It's just going to be out of the reach for too many people. So if we do have a slowing economic environment, it's going to be very challenging to try and find real growth if we start coming down on subprime credit availability out there for buyers. But it's important to note that if we do have any kind of a downturn, we think that those subprime borrowers may be more vulnerable. And exposure to those subprime borrowers varies greatly across the different brands out there in the marketplace. This is a chart that's looking from our dealer track data for the different brands of their vehicle sales that they've had so far in 2026. What was the FICO score band, the share of the market by the FICO score band? And the key takeaway here is you can see that on the far left, we have Subaru, Lexus, BMW. They have very low share of their customer base are buyers that have a subprime or a FICO score of less than 620. So we would expect that if there's any kind of a downturn in the economy, they're not going to be as exposed to those types of buyers that are going to be hit first because they're a very small portion of their sales portfolio. In contrast to that, we have the brands on the far right, like Kia, Mazda, Honda, Nissan. They have a much greater share of their customer base that is subprime buyers. And so if there is any kind of a recession, we would expect that these brands are likely going to be a little bit more vulnerable because their customer base is going to likely be taking a hit early on in any kind of a downturn. And then, of course, we can look at this by the different product segments. And it's kind of interesting that we can see that the product segments that have the best credit customers, luxury midsize SUV, full-size SUV, full-size truck, these have just a very small portion of their customer base as subprime buyers versus what we have on the far right, midsize car, compact car, subcompact car. In fact, some of the most affordable products in the new vehicle market, but they have the greatest subprime share. So they may actually hold up in sales because if we do have a significant recession, we may see a lot of people flocking to the most affordable products in the vehicle market. But in general, we would expect that those affordability segments may suffer because their customers are going to be likely hit first here in any kind of a downturn. So that's kind of a quick summary of what we're looking at the economy and what does it all mean for the vehicle market. Well, we're really not changing our forecast for what we're expecting sales to be, which is maybe a little bit surprising given all the crazy news that we've had out there. But this is a chart that's showing the monthly light vehicle sales SAR, or the seasonally adjusted selling rate. And I've also included the dotted line of annual sales. And so the SAR is jumping around what's happening on a monthly basis, and the dotted line is what total annual sales were for that year. And it's really revealing the volatility that we've had here in the new vehicle market over the last, 18 months, really since Trump came into office is when it really took off. But we're now maybe sort of past that. We've had a couple of months where the new vehicle SAR has been fairly stable, hovering around a 16 million sell rate. Our expectation is in June that we're probably going to see a similar rate as well. And so we've had about 3-4 months of the SAR being relatively stable, which I think is maybe indicating that for all the turmoil that we've had, the new vehicle market is maybe shrugging it off, that we're getting back to sort of more of the fundamentals, and we're not going to get derailed by some of the crazy economic news that is out there. Or it may just be it hasn't hit the fan just yet, and we're going to wait and see come here in the fall that maybe we are going to start to see ramifications from this. But where we stand right now, and from the slides I just showed you, we don't see any need to change our guidance for what we're expecting for 2026. So we still expect the vehicle market to finish down a little bit, about 2.6%. And finish at 15.8 million. And the used market as well, we're expecting to finish down about 1 to 2% from where it was last year. And I think those are fairly healthy numbers given, again, some of the uncertainty and certainly the weak confidence that we have out there from consumers and $4 gasoline prices around the country. I think that most folks would be hearing that would be pretty happy to have just these minor adjustments here to sales here for 2026. So let's talk about some of the trends that we're seeing in the market. We're starting here by talking about some of the big picture trends here on the left. And this is, I think, a really important slide because it's showing brand share of light vehicle sales from country of or the production country or the selling country's region. And the key takeaway here is you can see Asian brands in green. They are gobbling up market share. Really, in the post-COVID market, they've really been rising dramatically, gaining almost 5 points of market share over the last few years. And who are they gaining that market share from? Well, you can see in light blue are the American brands. Their market share is down significantly from the pre-COVID days. And that trend may continue here this year as well, given the weakness that we're seeing in some of the pickup truck segments. And we can see in orange, the European brands. They've basically held fairly stable, but they're down a little bit from where they were just a couple of years ago. And of course, the battery electric direct companies, the Rivians, the Teslas, their share of the market has been in decline as well. So the real winner the last couple of years has been these Asian brands. And certainly I think we can point to, and we'll talk a little bit more about this, but certainly their product portfolio has really what's been winning the day for them in this environment that we have right now. The other interesting thing is on the right. And what's happening with some of the luxury brands out there. Looking at luxury brands, these are the Audis, the Cadillacs, Lexus, the brands that we would consider the premium brands. They hit a peak back in 2023, but now their share of the market is starting to decline. And I think what we're seeing is this affordability issue is really starting to hit home as these European brands and these expensive brands are starting to suffer in this environment, as affordability is starting to squeeze even the more wealthy folks into having to compromise on some of the products that they're going to buy. So that's sort of a big picture overview. The other story is, of course, as I mentioned before, inflation pressures are rising, and some of that is self-inflicted. And this is a chart that's looking at new vehicle share of the market by the different MSRP bands. And the key takeaway here is that we're seeing that the market is moving to much higher price points. Back in 2016, 43% of the market, 43% of everything sold had a price tag of less than $30,000. In 2026, that's just 9% of the market. And when we look at the $50,000 share, well, now almost 50% of the market is looking at a $50,000 MSRP vehicle or higher. So this issue of affordability, concerns about these products being too expensive, well, some of this is by design. This is what the industry has been creating, as it's essentially been moving to much higher price points and abandoning the less than $30,000 price point, basically telling consumers that that's a used car price now, and that you have to go into the used car market for any kind of significant product selection. We are seeing some interesting changes, though, in the types of products that people are buying this year. This is looking at the top 10 largest product segments, which represents about 88% of all vehicle sales. And really, the key takeaway here is that all of these products are down, with the exception of mid-size car, mid-size truck, mid-size SUV. Mid is in. And it's kind of an interesting explanation. We would think that if affordability was really the main issue out there, we would see some of the most affordable products actually increase in sales this year, but that's not the case. Compact car, compact SUV, two of the most affordable product segments, are down the most. Again, I think that suggests that a lot of their customer base is really suffering, that they just can't afford these products anymore, and they've had to leave the new vehicle market, or probably used vehicle customers these days. But we're also seeing some of the more expensive segments, which are like full-size SUV, luxury mid-size SUV, even higher income product segments are down this year significantly. So it does suggest to me that there's sort of a consolidation around the middle, that maybe practicality is winning out, that I may want the bigger product, I may want the full size of something, but affordability concerns and practical issues suggest I'm going to get something a little bit more affordable. And that's what we're seeing, why the mid-sized vehicles seem to be doing particularly well. And just looking at the different brands out there, again, we can see most brands of the largest brands out there are in negative territory, but we are seeing some positive moves out there. And maybe the most surprising is that we're now starting to see positive year-over-year sales changes from Ram and Jeep brands. I think for the last gosh, I think since 2019, Stellantis has been losing market share. And so this, if they can maintain this throughout the course of this year, this would be the first year that Stellantis brands are going to gain market share, certainly in the post-COVID environment. So that's one of the big changes out there. And who is Stellantis going to be gaining share from? Well, in part, it looks like they're gaining some share from Ford and Chevrolet, two of their big competitors. As we see that Tesla, Ford, Subaru, Chevrolet are looking at very weak sales so far this year. And so I think this is one of the interesting things where product cycle becomes very important in the new vehicle market. Part of the reason that we're seeing Ram trucks go through the roof, well, they just released a new Ram 1500 that was just redesigned, and I think that's really having a big lift on sales. Why is Ford down so much? Well, the F Series is losing a bunch of sales, probably to the Ram 1500 because it's brand new versus Ford's truck is a couple years old now, and Ford pulled out of the Escape product segment. They no longer make their compact SUV. And so that's a whole bunch of sales that Ford has just abandoned in that product segment, and that's having an impact on their sales as well. So, we see the ups and downs of these different brands, but much of it relies not so much on their marketing strategy or pricing or distribution and all of that. It's really just consumers want the newest and greatest products all the time. And so it's very important to really do serious product planning, that you don't leave holes in your portfolio. And I think we've seen a couple of instances, like with Ram, like with Ford, where some of the product planning maybe wasn't so great that it is costing them some market share. The other interesting thing to point out regarding Tesla is they're down big this year. And it's not surprising given the fact that we abandoned the subsidies for battery electrics last fall. But the other interesting thing with Tesla is they have a whole bunch of off-lease vehicles that they have coming back to market. They leased a significant amount of Tesla Model 3s and Model Ys back in 2022, 23, and 24. Well, those vehicles are now coming back off lease, and that's an awful lot of competition for your brand new products. And you've got used products that are selling for 50% of the price. And Tesla hasn't really done many design changes. You look at a Model Y today versus a Model Y from 2022 or a Model 3 from 2022, it isn't going to look that different from the outside. And so I think they're going to learn that consumers are savvy, and they're going to be looking for some values out there. And that means that used Teslas are probably going to be more popular than the new ones here going forward. So the other issue we're dealing with, of course, is the inflation situation, and we're starting to see that in new vehicle prices. On the left is the average monthly transaction price. In May, it was $49,220. We're down a little bit from the peak of $50,000 that we did back at Christmas time, but it still remains quite elevated, but not growing at quite the rate that we had back just a few years ago. But on the right, you can see the year-over-year change in the transaction price. And you can see that red arrow. That's pointing that there's this upward trend of we had a big spike in prices during the lean inventory period. Prices were actually falling for a period of time in the new vehicle market, but now they're back towards positive territory. And in fact, prices were up over 1% from where they were a year ago. Our expectation is that we're going to see new vehicle prices continue to rise a little bit, but maybe not get to a very aggressive inflation rate, at least looking at this metric, because we're seeing that consumers are changing the products that they buy, that they're shifting away from some of the more expensive ones into some of the mid-sized ones, and that will mitigate some of the average overall price increase that we're seeing in the new vehicle market. But we're also seeing prices starting to rise for the used market as well. The Manheim Index that we released earlier this week was up significantly in the mid-month, and we're seeing that in the retail side as well. Currently, from our vAuto data, we can see that the average used listed price is $26,948, or almost $27,000. But really, the key story here is that the change in price, and that's on the right. Look at how much it is on a year-over-year basis. It's up 6% from where it was just a year ago. That's a big increase in used vehicle retail prices. Now, part of that is that we've had an influx of some relatively new vehicles that have gone into the used vehicle supply and some of the transactions out there. We have these used electric vehicles that are coming back. They generally have a higher price point, so that's lifting the average as well. But clearly, these inflationary pressures are rising out there, and supply remains relatively tight. So the situation could get more inflationary as we go forward through the summer. This is a chart from our vAuto showing the available supply that we have out there in the country. And on the left, you can see that we currently have about 280,000 vehicles on dealer lots across the country this week. That's up about 12% from what we had this same week last year. But we've seen a big decline in supply over the last few weeks. And in fact, over the last 3 months, I think it's fallen about 20%. So we are seeing some tightening here as we go into the summer season. And on the right is days of supply, or how long this inventory will last based on the current sales pace. You can see that our current days of supply is right around 77 days. It's about 6% higher than where we were 1 year ago, but it clearly remains, relatively tight to where we were just a couple of months ago. And so it is kind of creating this environment that could be inflationary if we see demand still remain strong and supply remains relatively tight. And one reason that it might remain tight is that we're seeing that the influx of the next model year vehicles is coming in a lot slower this year than it has in previous years. Right now, the amount of supply out there that's model year 2027 is just 2% of all available inventories. This same week last year, it was about 5%, and years before that, it was at 7%. So we're seeing that it's significantly less new product or the next year's product coming into market. My interpretation is that we may be seeing that the manufacturers are taking a much more cautious approach this summer. That they're not going to get aggressive with production. They're not going to try to roll out a lot of these new vehicles, given this uncertainty that we have in the economy and $4 gasoline. They may be trying to hold their cards a little bit closer to their chest. And so if you look last year, we saw a huge run up in available supply. After June, we saw supplies get back towards 3 million. I don't know if we're going to see that same behavior happen this year. That, as I said, I think manufacturers might be taking a little bit more conservative approach. And we look at the supply for the different brands, we can see that it's tightened substantially here over the last few months. Nationally, I have there in the middle, but we can see that across the board for all the different brands over the last 3 months, their days of supply has fallen significantly. But for the most part, the brands are all still in the same spot, at least relative to each other, than where they were before. We still have Toyota, Lexus, Honda, still looking at the tightest days of supply in the industry, very, very limited availability on dealer lots, in contrast to what we're seeing from on the far right, the brands with a tremendous amount of supply, like Jeep, like Ram. But I will say, at least Jeep and Ram are moving in the right direction. 3 months ago, they were looking at days of supply, well over 200. It's now fallen into the 150 range. And so they are moving in the right direction. And I think that's something that we're going to see continue for Stellantis brands as we are seeing that their new products that they've released to market are starting to really get some momentum out there. So all this means that incentives are probably going to remain fairly stable, that there's really not much need to get real aggressive to move the metal. And that's kind of been the strategy that we've seen from the industry so far this year. The latest data point we have on incentives as a percent of transaction price shows that in May they were 7.1%. And for the most part, it's been fairly stable over the last year. We've been kind of bouncing around the 7% range, well below the 10 or 11% incentive levels that we saw prior to COVID. So the industry is still trying to maintain a relatively conservative pricing environment. And it's certainly nowhere near the very tight environment that we had during the seller's market back in the spring and summer of 2022. But we thought that this might be a mechanism that the industry would use to manage the rise in tariff costs. We thought that a lot of pre-tariff supply would force the industry to use these incentives to pull back to try and maintain some of the profit margins that they had before. But that just hasn't been the case. And so we're kind of wondering, well, where is the tariff impact? Why are we not seeing a huge jump in prices if we know that these tariffs have been adding thousands of dollars to the cost of this vehicle? And I think what we're seeing is that the industry has been sort of hiding these costs. They've been making some changes in their production plans and reshoring, doing fewer imports, making supply chain adjustments. We have seen that destination fees on vehicles have been going up, so they're getting recouping some of that money through adding hundreds of dollars to destination fees. We see shrinkflation going on some of these vehicles, where a lot of times options are being stripped out of some of these vehicles. That if you want the adaptive cruise control or you want some of the other features, you're going to have to pay up for it, as opposed to them previously just including that in part of the package vehicle. And of course, and just margins are being compressed. The industry and suppliers and retail are just seeing in general that their margins just aren't quite as strong as they were before. So thus far, the industry has been essentially absorbing these tariff costs, but we are expecting that they still have the ability to sort of manipulate these incentives and get much more aggressive if they need to, in order to keep sales humming along. And they could pull back even further if they want to, if they find that they can up their profitability. They can use this as their lever to do that. So that's something we're going to be keeping an eye on. The last little bit I wanted to talk about is what we're seeing with hybrids. And I think this is the other big story of 2026. The consumers out there are just eating up these traditional hybrids. Just looking at the sales that we've seen so far year to date, on the right there, you can see the sales volume change. ICE vehicles down 5%, plug-in hybrids down 56%, battery electrics down 38% on a year-over-year basis. Traditional hybrids up 55%. We're seeing a huge change in market share compared to what we had last year. ICE vehicles have lost 3 percentage points of market share. Battery electrics, 3%. Plug-in hybrids, 1%. Traditional hybrids, they're taking it all. They're up 7% of the market. And that's just from compared to what we were doing last year. So that orange line on this chart, you can see it's rising dramatically. And this, I think, is a real opportunity for those manufacturers that do have products, the traditional hybrid products. Consumers appear to be very, very interested in these. And it's not surprising. There's certainly a big commitment with battery electric vehicles of range anxiety and residual values, all of that. You don't have those issues with a traditional hybrid. And certainly the high gasoline prices are making consumers that much more interested in these traditional hybrids. And so that's been a real game changer here in the market for this year. But not all the different brands are in a good situation to take advantage of that. This is a chart that's looking at each of these different manufacturers, what share of their sales are of these different powertrain types. And we can see Tesla, well, they're all green because they're 100% battery electric. But those that have a big orange presence, that's that traditional hybrid. And we can see Toyota leads the way, that probably a good 40% of their portfolio now that's selling is a hybrid vehicle. And Honda and Hyundai not far behind. And in contrast, you can see on the far right that there's a number of brands that just don't have any traditional hybrid product to offer out there. BMW, Mercedes, GM, VW, Stellantis, Nissan. They're way behind the curve in terms of having a large product portfolio. And I think that's really going to be detrimental for a number of manufacturers this year. And I think Tesla, too, having all of their eggs in the battery electric basket, they're going to suffer as a result of that, because a lot of folks that might have thought about buying battery electric have now decided they're going to want to start looking at traditional hybrids to get many of similar cost savings. So this situation is going to take years for the manufacturers to revamp themselves and get the products out there that they're going to need to make, given this is what consumers are demanding these days. But in the meantime, until that happens, I would expect these Asian brands that we saw in that one slide I was showing you, seeing their market share rise. I would expect that we're going to continue to see that here over the foreseeable future. And then lastly, I just wanted to talk about the lease maturity outlook. I know I've spoken to you about this before, but this is the other big story of 2026. We still have a whole bunch of used battery electric vehicles coming, plug-in hybrids coming. We leased in very aggressive numbers back in 2022, 23, 24, and now all those vehicles are now starting to come back. And so we're looking at tens of thousands of these battery electric vehicles coming back. And there's a lot of interest in these things. In fact, you can make an argument that a used Tesla is a pretty good bargain out there if you can get one, for 50% off of the price, because it's not that different than the new one that they're currently offering, as I mentioned before. So I think it's just be well aware as you're looking for your own products that you're going to be adding to your car dealerships out there, that there's going to be a lot of interest in used electric vehicles. There's going to be many more coming in the next coming couple years. And so I would suggest embracing that, because there's going to be real opportunity with these vehicles, because there's going to be some tremendous values to be had in those, particularly with elevated gas prices. It's certainly going to be a way to entice vehicle shoppers out there as a way they can save money by getting one of these vehicles. And some significant money here when we're looking at $4.50 gasoline. So those are my comments for today. If you're looking for additional insights, Cox posts stuff all the time. I urge you to come visit our websites and look for any additional information that you might find helpful. And please feel free to drop me a note if you've got any questions. I'd be happy to respond to you. So Rachel, those are my comments today.
Charlie, thanks so much for joining us today. We always look forward to your presentations, and I'll be anxious to hear how the fall shakes out when we have you back on. Again, you'll all be receiving a copy of this presentation and recording by early next week. To those on the line, join us back here Tuesday, July 14th at 2 p.m. Eastern as Aaron Kerrigan talks record buy-sell activity and what it means for the remainder of 2026. To learn more about AIADA, visit aiada.org. Thanks for joining us and have a great day.